Topic 3-3 Partnerships. Businesses are classified according to their type of ownership. So there are various different types of businesses, like limited liability, sole traders, corporations, etc., etc., etc. One of the types of business is a partnership. So this is when two or more individuals come together and own a business. So why do some people go down the partnership route? Well, partnerships are much easier to set up than large companies. Technically, there's no formal agreement required to set up a partnership, although it's a very good idea to have a written partnership agreement so that the structure of the business is set in stone. Partners are entitled to a share of the profits in accordance to their ownership ratio. The risk is shared among the two partners, but they are also responsible for each other's liabilities. So if one partner has a debt, technically the other owes it as well. There's no legal responsibility to disclose financial information to the public. And finally, the death of a partner means the partnership gets dissolved immediately. So although no partnership agreement is technically required, it's highly recommended we have one. So what exactly is contained within this partnership agreement? Well, it states how much capital is going to be put up by each partner, if they are entitled to interest on the capital they invest. It can limit the drawings of each partner. It states, is there any interest on these drawings? And it also discloses the way in which profits and losses are shared. However, as I mentioned, you don't technically need to have a partnership agreement. So if there isn't one, these are the things that are assumed. Profit and losses are shared equally, no salaries will be paid, there's no interest on capital, and loans via the partnership to the business are at a rate of 5% per year, and there is no interest on drawings charged. Accounting for partnerships. A major difference between sole traders and partnerships is the way in which capital and profits and drawings are calculated. For sole traders, their capital is the amount they invest plus the business's profits for the year, and you take away their drawings from the capital. However, in a partnership, each partner has their own capital account and contributes into the partnership's capital. Each partner also has their own current account to record their share of the annual profits and their respective drawings. Each partner also has their own ledger account where this information is shown, and I'll give you an example of everything I just mentioned. The capital account tends to be constant and only changes when there's a permanent increase or decrease in the capital contributed by a partner. So let's say that Alan and Mark have a partnership, each of them contributing $25,000 cash towards the business. But Mark also decides to buy a van for the business that's worth $15,000. The double entry for this would be, in Alan's capital account, we debit the bank by $25,000 and we credit Alan's capital account by $25,000. For the capital contributed by Mark, we debit the bank by $25,000, debit motor vehicles by $15,000, and credit Mark's capital account for $14,000, just like the ledger you see on your screen now. Goodwill. The main use of goodwill in partnerships is when a new partner is being admitted. The goodwill is used to reward existing partners for the value they've built the business to. So in the case of Mark and Alan, if they wanted to introduce a new partner, John, into the business, they would add goodwill into their accounts, reflecting the business's intangible value. The goodwill will be credited to Mark and Alan's capital accounts based on their existing profit sharing ratio. This would compensate them for the contribution they've made to the business's reputation. A mistake I used to make was assuming that goodwill somehow affected the business's profit sharing ratio. This is not true. The adjustment doesn't automatically increase the share of future profits for the partners. Rather, this would be decided in the new profit sharing agreement that would be drawn up by the new partnership. The current account in a partnership tracks each partner's share of the company's ongoing profits, losses, and the partner's personal drawings. The account reflects fluctuations in each partner's capital due to their earnings and withdrawals. The current account is completely separate from their fixed capital contributions. So, the way that profits are split among the partners depends upon what was agreed in the partnership agreement. Any additions made to the partner's capital, like profits, interest on their capital, and their salaries, are credited to their current account. Unlike the sole proprietor, the partnerships each have a current account and not a drawings account. This current account also records drawings made by a partner. The current account will be a fluctuating account, as profits and drawings will be added to the account as they are made. Anything that will increase the value of the current account goes on the debit side, whereas anything that will decrease the value of the current account goes on the credit side. At the period end, the capital account and the current account of each partner must be shown. While the capital account reflects the amount each partner has invested in the partnership, the current account records the share of the profit, drawings, and any interests they've made by each partner. The statement of profit or loss and other comprehensive income for partnerships. The only difference between sole trader income statements and partnership income statements is a new section at the very end called the appropriation section. The section goes at the bottom of the statement after the profit's been calculated. In this section, the partner's interest on drawings, salaries, interest on capital, and share of the profit is shown. So here I've given you an example of an appropriation account. These values are then transferred into the partner's current accounts. Remember, anything that will increase the value of the account, like interest on capital, is on the debit side, while anything that will decrease the value of the account, such as drawings, is on the debit side. Changes in the business, even from things as small as changes in the profit sharing ratio to admission of a new partner, means that the previous partnership agreement is completely terminated and a new one has to be drawn up. During this period, assets are revalued and each partner is entitled to a gain or a loss in the net worth of the business. So, for the admission of a new partner, goodwill is temporarily introduced into the accounts when a new partner joins to reward the existing partners. It's credited to the existing partner's capital accounts based on their current profit sharing ratio. The new partner contributes capital based on the agreed terms, which may involve adjusting the existing partner's capital accounts. The goodwill is then written off by debiting all partners' capital accounts according to the new profit sharing ratio, ensuring that goodwill is removed from the accounts and the new profit sharing arrangement is fairly reflected in the partner's capital. This process ensures that the new partner enters the business on fair terms, with the existing partners compensated for the value that they contributed to the business. When a new partner is admitted into the partnership, the existing partners need to be compensated for the goodwill they have built in the business. Goodwill represents the intangible value of the business, like its reputation, customer base, and brand recognition. It's considered an intangible asset that adds value to the business but doesn't appear in the account unless an event occurs, like a partner joining. So, how is goodwill accounted for? When a new partner joins, goodwill is temporarily brought into the accounts to recognize the contribution of the existing partners. This is done by debiting the goodwill account with the value agreed upon and crediting the existing partners' capital accounts in their current profit sharing ratio. For example, if the goodwill is valued at 30,000 and the current profit sharing ratio between the two existing partners is 60-40, the goodwill is credited to their capital accounts as follows. Debit goodwill account by 30,000, credit Mark's capital account by 18,000 and credit Alan's capital account by 12,000. This rewards existing partners for building the business's goodwill, reflecting their share of its value. The new partner's capital contribution. So let's say the new partner, John, will then contribute capital to the business based on the agreed terms. The new partner's share of the business, including their rights to the business's assets and liabilities, is determined during the negotiations and then outlined in the new partnership agreement. This contribution of capital is recorded in the new partner's capital account. Next, we need to write off the goodwill. After goodwill has been recognized and credited to the existing partners, it's usually written off. This means eliminating the goodwill from the accounts by adjusting the capital accounts of all partners, including the new partner according to the new profit sharing ratio. This is shown on the next slide. Goodwill is credited, meaning it's removed from the balance sheet, and the partner's capital accounts are debited according to the new profit sharing ratio. The adjustment ensures that goodwill is no longer carried as an asset, as it's intangible and usually not kept on the books unless there's a specific need. So here's an example of writing off the goodwill. Let's suppose the new profit sharing ratio among Mark, Alan and John is 40-40-20. So the entry would be debit Mark's capital account by 12,000, debit Alan's capital account by 12,000 and debit John's capital account by 6,000. And then finally to credit the goodwill account by 30,000. This entry eliminates the goodwill account and adjusts all the partners' capital to reflect the new ownership structure. So why is goodwill written off? Well, goodwill is written off because it represents an intangible benefit, like reputation, that don't need to be carried on to the balance sheet permanently. Writing it off ensures that capital accounts are fairly adjusted after the new partner joins, reflecting the updated profit sharing ratio and the fact that the existing partners have been compensated for their contribution to building the goodwill. This process ensures fairness between the old and new partners, as goodwill is no longer held as an asset once the new partner joins. Retirement of a partner. Similarly to admitting a new partner, when a partner retires, the assets of the business may need to be revalued to ensure that the departing partner receives their fair share. This revaluation reflects the current value of the business and ensures that both the retiring and remaining partners are treated fairly. So when a partner retires, goodwill is typically introduced into the accounts. This is done to ensure that the retiring partner gets credit for the business's intangible value, like its reputation and its customer base. The value of goodwill is credited to the partner's capital accounts, including the retiring partner, based on the existing profit sharing ratio. So let's say that John decides to retire from the partnership, and to make it simple, let's say they all have an equal share. So what will we do? Well, we have to debit the goodwill account for the 30,000, credit John, Mark, and Alan's capital accounts for 10,000. After the retiring partner has officially left the business and his shares credited, the goodwill is written off. The goodwill is debited to the remaining partner's capital accounts according to the new profit sharing ratio. So now that John's left, let's say that Mark and Alan go back to splitting the profits 50-50. So we debit Mark's capital account by 15,000 and debit Alan's capital account by 15,000, and then we credit the goodwill account by 30,000. The retiring partner's share of capital, goodwill, and undistributed profits is paid out. This can either be in cash or in installments. The statement of financial position. Like in the statement of profit or loss, the statement of financial position is very similar to a regular sole trader statement. However, the difference being is in how the capital is recorded. Now, the individual amounts for each partner should be shown within the statement. So like the example I gave, you can see the capital account for Mark and Alan is separated into the 40,000 and the 25,000. Similarly, I've done the same with the current account, where Mark's current account value is 10,200 and Alan's is 13,300. Just to note, if the current account balance for a partner is a debit balance, it's subtracted from the capital. Now that's pretty much everything for partnerships. If you've got any questions or you want me to make an extended video, please let me know and I'll go through the details and we'll make a nitty-gritty video on this topic. Thanks for watching. See you in the next one.